Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm joined today with a dynamic guest, Lynette Zang, Chief Market Strategist for ITM Trading, analyst of the markets. Since 1995, ITM has been a full-service precious metals firm specializing in gold and silver products, ranging from bullion to rare gold coins. And, obviously Lynette has made such a big splash in the markets over the last couple of years, and it's an honor for us to have her on the show. Let's see, 1-888-OWN-GOLD if you want to get in touch with Lynette and ITM and get some gold. So, and other precious metals, of course. So Lynette, thanks for coming on Crush the Street with me today.
Well, Kenneth, it really is my pleasure, and thank you very much for that wonderful introduction. I'll just add one more thing, because I've been a banker, I've been a stockbroker, and most importantly, I've really studied currencies since 1987. And what we do is actually a customized strategy based on each individual's specific goals, needs, circumstances, and what they have to work with. And so we try and position each individual into what's going to support them. But it's all based on the strategy that I created for myself, just with tweaks because everybody's a little different.
Sure. So how has that strategy, I mean, we talked earlier this year, how has that strategy changed, if at all, with the dynamics that we've seen with gold moving higher into the year, and obviously stocks going into all-time highs, all-time high after all-time high, the interest rates, I mean, the Fed chairman coming out and kind of pivoting and U-turning the direction of interest rates. Has any of that changed as we now discuss this in December of 2019?
The only thing that's really changed in my strategy, because I just keep, I lay out everything in there and I just keep accumulating the different kinds of gold and silver to support different goals. But at the other side of the reset, that's when we have a new currency and all of this debt and all of this garbage is wiped out. I used to think that I would convert most of my gold and silver holdings back into that new currency. However, since I now see that we're going into a digital universe where they can continue to basically rob its value, because you can do so many places after the period, like in a dollar it's 1.00. No, when we go into digital form, there's lots more zeros. Then what has really changed is I intend to hold more gold than I had thought I would at the end of this. I mean, you should always have some level of gold and silver physical in your portfolio, but depending upon where you are in the trend cycle would determine how big a percentage that needs to be of your portfolio, and also the kind that you would need to hold. So that's really what's changed. That I would say I'm more voraciously accumulating, because I understand the underlying truth, not what they just want you to think. With, as you said, these markets going higher and higher as we've entered an earnings recession. That makes a whole lot of sense.
You reminded me of something there, Lynette, talking about derivatives and then the zeros and the digits. FDIC, I heard you talking about this, that $250,000 insurance policy that the major banks have. How much more leverage is out there just because of this, in your opinion? I mean, how crazy have things gotten because of this backing that the government has given banks?
Well, first of all, if you read about it, they don't call the FDIC an insurance policy. They actually call it a scheme. And I have not looked at the DIF report just recently, and that is telling you how much they actually have to insure those deposits. But I believe that it's somewhere less than 2 cents for every dollar of insured deposits. That's what they actually had in that DIF account to pay out. When we went through the crisis in 2008, according to the FDIC, they were one bank failure away from everybody knowing that they were insolvent and out of money. One bank failure away. And so they managed to, raise the rates a little bit. And so now instead of being, well, they're still insolvent if you have less than 2 cents to insure every dollar, as long, whoever is left last, whoever is the bank that folds is left last, well, you're not probably going to get your money because they don't have it. It's just about instilling your confidence so that you keep your wealth inside of the system. But that's why they created the bail-in laws. And what's interesting particularly about that is just recently in Germany, a bank was bailed out. I can't remember the name. I can't remember the name off the top of my head, but this just happened. I'm going to be talking about it tomorrow. And what did they do? Instead of having the bondholders take a haircut, they're putting in taxpayer money, which is exactly what they said they weren't going to do. So, will depositors be bailed in? Yeah, depositors are going to be bailed in, and the banks are going to be bailed out, and the taxpayers and the citizens are going to be left on the hook again.
Wow. Well, what sort of disruption of our normal would that be? I mean, 2 cents out of every dollar to ensure, if we want to call it that, or a scheme. I mean, I didn't even know it was called that.
Oh yeah, I didn't say it. I mean, I do think it is a scheme, but that is actually how they refer to it. All over the world, when they talk about deposit insurance, it is a deposit insurance scheme. Yep.
So I would say there's probably a lot of people who, are obviously living paycheck to paycheck, right? I mean, I think you put out in another interview I was listening to, you said $400 is what most people couldn't afford to come up with if they needed it.
Exactly.
But that's
the,
let's call it the more extreme example. Let's talk about, maybe someone who thinks they are pretty well off. They're pretty stable. They feel like they got a good job. They're comfortable with their mortgage. But in a disruption where, there's really a lot of instability, the collapse is going to really start to impact people who otherwise thought they were insulated from this. And that's what I think a lot of people's reality and normals, that's when it's going to be really interrupted. When people who really thought that they were fine, all of a sudden have their world turned upside down on them.
Exactly. Because part of what that will look like are bank holidays. There won't be a holiday for you or me, but you will have a minimum access to the funds that you're holding in the bank. And who knows how much of that is going to get bailed in and just go away. I mean, they tested it, so would they live up to that $250,000 limit? Well, they tested it in Cyprus. First, they were just taking 100% of it. And then because the whole world went, but wait about deposit insurance. So then they backed off, but you still didn't have access to all of the funds that you held in the bank. So people are going to be, chances are that they would allow credit cards to continue to go through because they want us to transition into holding all of our wealth digitally. It's easier for them for governments, a lifetime tax and track what you're earning and what you're spending, et cetera. These are the things that they've talked about. For central banks, then it is easy for them to push a button and take us as deeply negative on rates as they need to get us to spend whatever we have in the banking system. So I'm thinking that it is possible, because this is really what happened in Greece too, where more cash was used and they wanted to get people to use more digital money. So It's possible that some of these transactions, as long as they're done digitally, might still go through, but your access to what you're holding in there is going to be limited. And that'll be a rude wake up for most people because they can't conceive that it's not their money. But the reality is, legally, when you make that deposit into a checking account or a savings account, since 1995, legally, the banks have the right and the ability to sweep those funds into sub-accounts and then do whatever they want to do. Use that equity to borrow for their benefit, and then they can do, the derivative bets or anything else that they want to do with that money. It's really not yours. And I do think people are starting to learn that now. It's been quite interesting here that there have been a number of times when a client has gone to do a wire transfer for a purchase, and the bank said, no, we're not going to do it. Well, wait a minute, that's my money. No, not really. It's not really your money. So better to understand what's happening now and get into a position now than wait until it becomes obvious to you as an individual, because when that happens, it's too late. You won't be able to do anything about it.
So one thing, I was listening to Jeffrey Gundlach, the new bond king. They're saying he's talking about this next collapse, this next recession, being one that the stock market never recovers to where we are now. I mean, this market euphoria we're seeing. I think Ivanka Trump put something out that reminded me that, we've now seen the 119th record close for the stock market as of yesterday. I mean, so just ongoing, this blow off top that we're seeing in stocks. And again, what a new normal that is, to not see a new high for, 2-3 decades. I mean, that would be a totally new normal for what we've been used to for the last so many decades, right?
Well, yes, but Japan's stock market and their real estate market never recovered their highs, right? When that imploded in the 90s. However, all of this is in nominal terms. In other words, people marry numbers. So as the stock market makes new nominal highs, the value of those corporations and the value of the purchasing power of the currency is declining rather precipitously. And this regardless of what anybody says, based upon going out there when you're buying something. Is what you're buying costing you less, the same, or more? Is your medical insurance, is that staying the same or going down or going up? Is your education, food, all of that? That's your purchasing power. So in nominal terms, we go, whoa, look at this, the stock market's making all these new highs at the same time that you have record amount of the average person fleeing the stock market. Wait a minute, how's that work? Isn't this supposed to be a supply and demand economy? There's real problems. Jeffrey was also talking about the fact that I believe it's 39% of the corporate bonds that are out there, even though they're graded by the grading services to be investment quality, BBB and higher, that they're actually junk quality, junk. And everybody knows what junk is. So, you have to be careful when you're looking at the markets. Inflation causes nominal confusion. So in other words, we marry those numbers. But if you had a $20 bill 10 years ago and you have a $20 bill today, do we all know that you cannot buy the same amount of goods and services with that $20 bill? Right?
Absolutely. Well, and on that note, I mean, you were talking about bail-ins, and that would be a very real wake-up call for people. But inflation, they sneak it in. And going back to Jeffrey, sounds like we might have listened to that same interview. uh, he was talking about the fact that it seems like the Fed wants inflation to outpace interest rates so that we can monetize and grow our way out of these deficits and debts that are looming over the US over the long term. So, I mean, how long can that go on for? And does it buy them time to possibly, you know, experience some windfalls, some breaks to really get ahead? I mean, I don't know
Well,
if that's even possible, but you know, maybe
well,
they had,
Kenneth,
you know, maybe the US can attract, you know, trillions of dollars away from China or other parts of the world that backfills, you know, the years of damage that have been done.
well, that's what the QE was about in 2009. Right? They wanted to create that inflation to then stimulate the economy. How much were all those trillions and trillions and trillions of new dollars that have been pumped into the economy? And yet here we are 9, 10 years later in heading into, well, a continuation of a global slowdown. Global. That includes the US. So the bottom line is it works until it doesn't. And it's worked since 1971. That's when we became debt backed. But if you stop and think about it, debt can make it look like growth. So for example, if I go out and I decide that I want to buy a car, I have two choices. I can save up the money and go and buy the car. Or I can put a small amount of money down and borrow the rest of it and buy that car and pay it back with future dollars. So if I do that, I'm driving around in a brand new car and you go, wow, look at her, she's doing really well. Except that I have all of that debt on me. At some point, when I've taken on so much debt that most of my income goes to service the debt, that's money I've already spent. I can't spend more once I've hit my debt limit. That's really what the question is. What is the debt limit, particularly of the consumer? Because everybody knows globally that they're counting on the consumer to carry this massive mountain of debt and yet keep spending. But as you said earlier, if in an emergency, most of the people in the US could not come up with $400. $400. Last year it was $500. This year it's $400. So I'm thinking we have really maxed out our credit cards, and we're seeing more and more defaults on auto loans and in other areas, and that will just get worse and worse. So how long can it continue? It can continue until confidence is lost. That's what makes what's been happening in the repo markets so significant, because that really is all about markets. And what most people don't understand is that what typically funds the repo markets are money markets that we've been trained to think of as super safe. And yet those money markets froze. And because they didn't want you to know it, it happened in 2008 too. And they didn't want you to know it. So they panicked. Central banks, the Federal Reserves panicked. And I'll send you the links, Megan. Those, would you send Kenneth those 3 links? So you can watch how much money is going into the repo market and how much new money is going on the Fed's balance sheet to try and hide this. But the problem is that according to their studies, so I'm talking about the International Monetary Fund, the Federal Reserve, and the Bank for International Settlements, so all these big bankers, is that it is the more they do, the less impact that it has. And now we're hearing regularly whether or not does the individual trust what the ECB is saying as their inflation target. And he did say, yeah, the Federal Reserve is also planning on running hotter inflation to average out that 2% a year. Well, I remember because I'm 65. So I remember in the early 70s when inflation was actually a bad word. Now we need that inflation because that's how we will grow the way out of it. No, that's how you reduce the value of the currency so that you repay the debt with cheaper and cheaper, in this country, dollars. Part of that is in the strategy that I'm utilizing for myself that we help people understand and position for. But can they do it forever? No, the confidence is too far gone.
Lynette, one of the things that we know as of recently is the US has had the strongest stock market in the world. Conventionally, it's deemed as strong. Trump believes that we should have lower or even negative interest rates
Oh
because,
yeah, he likes negative rates.
absolutely. He thinks that why should the US have to pay more for a superior product? And I guess I understand that to a certain degree, except that negative interest rates isn't free market, right? That doesn't make sense.
Well,
Um,
exactly.
but
And what
but
the
in this
negative rates.
matrix that we are in, with the world
Mhm.
operating without real fundamentals, I mean, everyone, on drugs per se, walking around like,
Free money drugs.
zombies waiting to
Yeah.
keel over. It's an interesting dynamic how nuanced the chess field is. You know what I'm saying?
Yes, I do. They are, now that we've had negative rates for a while, since 2009 in some countries, they are discovering, I don't know, shocker. I mean, I think it's pretty obvious, but they're discovering that it has eroded the ability of the banks there to turn a profit. So you've got all of these zombie banks. If you bring negative rates here, I mean, if somebody pays you to buy a house, are you likely to buy a house?
Yes,
I'm going to pay you to do it, Kenneth.
I'm going to do it.
Exactly. So what does that do? If you look at Denmark, it pushes the prices of the houses up, but it destroys the foundation of their economy because their banks are in deep trouble. So negative rates are an irrational experiment. It doesn't make sense for me to, I'm working my butt off and I'm going to loan you money knowing that I'm going to get less back. And at the same time, the value of what I get back is also lower, right? That makes no sense. That does not create a strong financial foundation. What it does do is it encourages a lot of risk taking. So what's really happened across all of the markets is that, everybody is reaching for yield and taking a tremendous amount of risk that they're not even paying attention to because they're going to give up, they're going to get a teeny bit of income. It's not worth the level of risk that they're taking. And unfortunately, they won't know this until it's too late for them to do anything about it. The
So
time to do it
conventionally,
is
the
now.
U.S. is strong, but
How
one
is
of the
the
things
US
you pointed
strong?
out is that there's a lot of things being hidden. So
Yes.
if we factor that into the equation, are we as perceivably strong against other countries, or are other countries arguably in a better spot than even the U.S. is at the moment, in your opinion?
The US is maybe the best horse in the glue factory, but we're all in the glue factory. And if most of our citizens cannot come up with $400 in an emergency, how are we better off?
Hmm.
I mean, how are we better off? Let me ask you that. Nutritionally, we're eating degraded food. And by the way, I know this is off the topic, but only minorly, because in India, that in 2016 took away what, 85% of all the cash. They are really, their citizens are barely getting by nutritionally. with a lot of them just eating, the bread with a little chili in it because they can't even afford eggs or milk or anything like that. And I think it's critically important, not just with the gold or silver, but no matter what does each individual need to feel safe and secure? Food, water, energy, security, community, barterability, wealth preservation, and shelter. So no matter what's going on, I don't see that the US is all that strong. I see a tremendous amount of wealth transfer. I see a tremendous amount of allowing technology companies to come in and create, destroy local economies. In other words, like Amazon, they didn't have to make money for 10 years or 12 years or more. But what they did is they'd go into an area and they would destroy the local mom and pop shops, which were really the people that generated the best jobs. I'm not saying Amazon isn't generating jobs, but from my reading and my studying, most of those jobs are not that great, and you have to keep pace with the machines. So they have more accidents, etc. But this was allowed. It was allowed for Facebook to get this big and Google to usurp and take all of your information so that you become the cow. Okay, it's not, and they're the butchers, and they're going to take all of your data and they make money from it. They own your data. Why was that allowed? Because it was beneficial for the governments and the central banks to enable that to happen. And now they're going to try and regulate it, but they're really going to utilize all of that new technology to control us more. And we're going into a surveillance economy, and I'm not happy about that. I'm not happy about it at all. So, the way that you fight that is to make sure that you are as independent as possible. So you grow your own food or you have a food store. You make sure that you have water no matter what. I'm doing it with ponds. Yes, I have to filter the water, but I've got water. You look at where are your holes, and you don't just have all your wealth inside of a system that it's intangible. Here, grab it. You can't grab it. It doesn't really exist. Just in your mind, just in your perception that this is wealth. But this will have more value because maybe somebody needs a vessel to hold water or something to drink in. You've got to have some wealth that is completely outside of this system. It's got to be tangible because that's what you're going to need if the grid goes down or when the markets go to Hades and when everybody loses the confidence in these central planners. You better be able to take care of yourself. And I feel really strongly about that because I'm looking at what's happening in different parts of the world, and it's the little guy that gets crushed. Not okay with me personally.
Lynette, I'd like to ask you a little bit about what's going on with palladium. Obviously, been in a massive bull market. Is this related to what is going on with precious metals? I mean, is this a precious metals move that we're seeing? Any insight on what is happening in the palladium markets, and does it have to do with all the things that we're talking about right now, the instabilities around the world?
Well, I don't really track palladium because it is not a monetary metal. It is an industrial metal. And I mean, it's used a lot in, like in automobiles, but there's been a global glut. So I'm sorry, but Kenneth, I don't know what's happening with palladium because I focus on monetary issues.
Sure. Well, I was just hoping to get your thoughts on that, but I appreciate your honesty.
I'm sorry.
Yeah. No.
I try to know as much as I can. I read constantly, but I don't really track palladium.
You are brilliant.
Thank you.
Appreciate that. So let's talk a little bit about, the gold to silver ratio at the moment. I mean, we're around 87. gold seemed to kind of take a breather here after we had that U-turn, that pivot from the Fed, and we've just kind of been hovering around below 1,500 now. Silver's come down a little bit, and we're obviously seeing the miners start to waver, lose some ground here, as the market just tries to figure out where gold's going to go next. So what are your thoughts in the current environment regarding, interest rates and gold just seemingly confusing and scaring a lot of investors? Because obviously over the last 9 years, it's been hard to predict what is going to happen in gold, and gold has disappointed a lot of people since 2011.
Well, for one thing, it is really critical for you to understand that a rise in gold price is an indication of a failing currency. And so when you're referring to gold, you're referring to the spot gold market. And we've been trained to think that that's gold, but that's Wall Street's gold. And according to, don't change behavior, change accounting. But according to the Bank for International Settlements, before they changed the way that they accounted for the gold derivative contracts, that's all they are, they're contracts, they're not real gold. There were 62,000, for every 1 physical ounce of gold, there were 62,000 derivative gold ounces of gold that were issued. So it's easy and it's cheap. Through the CME group, it's $150 to control 500 ounces of gold. So understand that they do not want you in gold, because as soon as you buy physical gold, it is out of the system and out of their vision and their ability to really control. So the spot markets are used primarily as a trading tool and a perception management tool. And if you read any of the documents from the central banks, they actually even talk about it. Gosh, can't believe I forgot. Alan Greenspan, my mother would be like, what? She used to say to me all the time, well, Lynn, don't you think Alan Greenspan's smarter than you? Don't you think he is? And I'd say, Ma, he's got a very important position, so I certainly hope that he's smarter than me. But if he believes the garbage that's coming out of his mouth, then no, he is not smarter than me. He didn't believe the garbage that was coming out of his mouth. But what he did say is, what if we tweak the price of gold a little bit, and that would impact the psychology? That's not an exact quote, but that's essentially what he was talking about. So if you understand that when you look at the spot markets, they reflect the current market price, that's what creates the opportunity for us. Just like the central banks are buying it like crazy, we should be buying it like crazy. But it does not impact the true fundamental value of gold. And to know what that is, it's pretty simple. Of any asset or any instrument, you simply look at all of the different functions that it was designed to perform and determine which is the most important one, not to you, but to the creators. When they were looking at creating a monetary system and money, that they needed it to be universal and all sorts of things. But the key piece was they wanted it to have stable value so that it could hold its value over time, which is exactly what gold has done for 2,000 or 6,000 years. An ounce of gold 6,000 years ago would buy a great suit of armor. In the early 1900s, it would buy a great men's suit. And today, even at 1460, 1500, I'm thinking you can probably still buy a pretty nice man's suit for 1,500 bucks. So it holds its value over time. We've been trained to just think of money as simply a tool of barter. Okay, I'll give you this, and then you give me something. But by design, inflation robs its value. So if you attempt to save it for retirement, well, by the time you retire, who knows how much purchasing power value it will have. It's already lost more than 96% out of the original dollar. So when we're looking at the charts and the graphs with gold, it just completed when it had that recent run. The bottom was hit in 2016. Here we're going into 2020, but the bottom on gold was put in on spot gold was put in 2016. So here it rose pretty rapidly to conclude a smaller cup formation, not the big one. That will happen when it hits that 1900 and goes above that. Then the full cup that started in 2011 will be in conclusion. That could really happen anytime. We're not really all that far from it, and that's what all the money printing is about. Oh, we're going to print money. Well, when they print money, it goes into the banking system and then it's got to go someplace. Stocks, bonds, unicorns, look at WeWork. Look at how much Adam Newman walked away with. Not all the employees, they were left holding the bag. But Adam Newman, boy, he sure made out well on that. And I'm not sure today that will ever be a very wise business plan. However, all of this money printing really created that. The true value of an ounce of gold will express itself when the central bankers and the government fully reset the currency, just like Venezuela, right? They revalue the fiat money against real money, gold, and that's when it'll express, which is way north of $10,000 bucks.
Wow.
So, I mean, you say, wow, but that's still in nominal terms. It's in your purchasing power.
Right.
10 trillion times zero is zero, right? Look at Zimbabwe. I mean, they're still dealing with it from their currency reset that started, their hyperinflation that started in 2006. And at one point, they were the breadbasket of Africa. They had a very strong economy, and it's destroyed, absolutely destroyed.
Well, but that goes to show that not being in the right asset, you will get left behind.
Exactly.
Even if you're not getting much ahead, being left behind to that degree could be extremely devastating, as you're pointing out there. I mean, even to a certain degree, I think about a lot of people, my peers, my age, people who don't own real estate or don't own assets. Asset prices have gone up, and now many of my friends, they want to buy a home and they want to move out, they want to get independent, but to get into the market now, they got to buy homes that are 2 and 3 times more expensive than they were when they exited college. They got out, they graduated high school, and their paychecks haven't grown that much. They'd be lucky if they have a job, right?
Exactly.
So the importance of not being left behind as the dollar deteriorates, I mean, it's huge.
Yeah.
So maybe you could just share some closing thoughts there as we round out this interview. And of course, let everyone know where they can go to learn more about you and what you do and the precious metals you sell and the strategies that you help people customize for their own personal situations.
Absolutely. And so to address that first comment about real estate, now I don't know exactly what it's going to look like, but my personal feeling is that it'll probably look very similar to what happened in Japan. And during when their bubble burst in the early 90s, residential real estate dropped 85%. So now you have real estate dropping like this at the same time they're resetting the value of gold in terms of the fiat money, right? It's not that gold goes up so much because it just maintains its value. Mm-hmm. However, since that value has been suppressed, I always think you should do what the smartest guys in the room are doing for themselves. And central banks globally are buying more gold than they have even when Nixon closed the gold window in 1971. So it is severely undervalued. And I think that when you're looking at what you're going to invest in or buy, you want to look at what is undervalued, but in a long-term positive trend. What is overvalued and in a long-term negative trend. It may seem obvious that you want to put most of your wealth and hold most of your wealth in an undervalued asset that's in a long-term trend. That's gold and silver. And you look at the charts and you know you're in a positive trend when you see a series of higher and higher lows. Not short term, because it's easy and cheap to manipulate that market. But you look at it long term and you want to see a series of higher and higher lows. If you see that, and that will continue to happen, you're going to get higher highs. So you want to buy the bargain. Then when that shifts, that's when you make the decision and the shift into those other markets. And what you're looking at, and this all goes to the strategy as well, what you're looking at is accumulation patterns. And one of the most powerful is called a cup formation. That's not like perfectly smooth. You're going to have your jags, but you're kind of looking at this, right? And what over a long period of time, and what that tells you is that smart money has recognized an undervalued circumstance and they have quietly begun to accumulate. That's when you want to do it too. So if you can figure out, and this is something that I show in all of my work, how to know what the smartest guys in the room on any given topic are doing for themselves, and you have the ability to emulate them, then you are most likely to be in the right place at the right time with the right asset. Make
Well
sense?
said.
So that's, it isn't just the strategy that we give you and go, oh, have a nice life. But we actually educate you. We're super keen on education so that you can actually do some of this for yourselves. But we help mold that strategy for you based upon, your personal goals, because anybody can really start to execute a strategy. Even if you don't have a lot of money, silver, which is the secondary monetary metal, and as you pointed out, super dirt cheap, $17 an ounce. You can afford $17 an ounce. Pretty much anybody can afford $17 an ounce, right? You can buy dimes. You can buy, a tenth of an ounce or a half an ounce or quarter ounces. There's ways to accumulate this, even on a small scale with a limited budget. But also part of the strategy is to get you in the best possible position to survive the reset and then thrive on the other side of the reset. And, history is really the best guide to that. Because history has a tendency to repeat.
Lynette, thank you so much for taking the time here, year end, getting close to the new year. Again, thank you for coming on Crush the Street and just sharing your wisdom with us and kind of giving us an idea how to enter 2020, what is going on in the markets, and really a reminder on how to be prepared with all the distractions that are going on around us. So again, thank you so much.
Oh, Kenneth, it is my pleasure. Thank you so much for having me. And, I love the questions, so we'll have to do this again.